In 1973, a Princeton economics professor named Burton Malkiel published a book that the financial services industry has been quietly hoping you would never read. The book was called A Random Walk Down Wall Street. Its central argument, made with academic rigor, backed by decades of market data, and verified by every subsequent generation of financial research, was devastatingly simple. The majority of professional fund managers, the people paid enormous fees to select the best stocks and beat the market, do not beat the market. Not sometimes, not in bad years. Consistently, over time, when you account for their fees, they underperform. The average investor who simply bought the entire market, every stock, all of it, at the lowest possible cost and held it without touching it, did better than the professionals paid to outperform it. The financial services industry has had 50 years to absorb this information. They have spent most of those 50 years finding ways to make sure their clients don't act on it, because a client who understands index fund investing does not need a financial advisor charging 1% of assets under management per year. A client who understands index fund investing does not need actively managed mutual funds with 1.5% expense ratios. A client who understands index fund investing is, from the industry's perspective, a problem. You are about to become that problem. Shelley, who you met in Script 3, the woman who finally closed the tab on a Wednesday evening and opened her Roth IRA after 4 years of meaning to, made her first investment choice the same night she opened the account. She typed, "What should I invest in for a Roth IRA?" into a search engine and spent 40 minutes reading increasingly complex articles about sector allocation, bond ladders, dividend growth strategies, international exposure ratios, and something called a 3-fund portfolio that seemed simple until the article started explaining the specific percentage split and whether it should adjust based on her risk tolerance as assessed through a questionnaire she was now apparently supposed to complete. She closed the laptop without investing anything. Again, the next morning, her coworker asked if she had managed to open the account. Shelley said she had opened it, but hadn't invested anything yet because she was still trying to figure out what to buy. Her coworker looked at her. Then she said something that ended 4 years of financial paralysis in one sentence. "Just buy the target date fund for the year you turn 65. You never have to think about it again." Today, we are talking about the investing approach that financial advisors hope you never find, not because it is complex or risky or inappropriate for women without a finance degree, because it is so simple, so well evidenced, and so devastatingly effective that understanding it eliminates most of the reasons the industry uses to justify its fees. And because when women find it, they use it. And when they use it, they build wealth at a rate that makes actively managed alternatives look exactly like what they are. The evidence. Let me start with the evidence, because the evidence is so clear and so consistent that the only reason most people have not acted on it is that nobody has laid it out plainly enough. Study 1. S&P Dow Jones Indices publishes an annual report called the S&P IVA Scorecard, Standard & Poor's Index versus Active. It compares the performance of actively managed funds against their benchmark index over multiple time horizons. The 2024 findings. Over a 20-year period, 92% of large-cap actively managed funds underperformed the S&P 500 index. 92%. The professionals, with their research teams and Bloomberg terminals and decades of market experience, underperformed a simple, unmanaged index fund 92% of the time over 20 years. Study 2. Nobel Prize-winning economist Eugene Fama spent decades researching whether professional fund managers could consistently identify mispriced securities and generate above-market returns. His conclusion, supported by an enormous body of empirical research, was that in efficient markets, which most major markets are most of the time, consistent outperformance through active stock selection is not achievable. The market has already priced in the information the fund manager is using to make decisions. Study 3. Warren Buffett, arguably the most successful active investor in history, has consistently recommended that most investors, including the trustees of his own estate after his death, put their money in a low-cost S&P 500 index fund rather than trying to replicate his methods. The man who beat the market for 60 years is telling you not to try to beat the market. That is a significant data point. The evidence is not ambiguous. The evidence is not contested by serious economists. The evidence says the same thing it has been saying since 1973. For the vast majority of investors, the simplest possible strategy, buy the entire market at the lowest possible cost and hold it without touching it, produces better outcomes than almost any alternative. What index investing actually is. Let me explain this as simply as it deserves to be explained, which is very simply indeed. A stock market index is a list. The S&P 500 is a list of the 500 largest publicly traded companies in America. The total market index is a list of every publicly traded company in America. A global index is a list of every publicly traded company in the world. An index fund is a fund that owns a small piece of every company on the list. When you buy an S&P 500 index fund, you own a tiny piece of Apple, a tiny piece of Microsoft, a tiny piece of Amazon, a tiny piece of 497 other companies. Not because you chose them, because they are on the list. The fund buys them automatically in proportion to their size, without any human making active decisions about which ones to buy or sell. When the economy grows, when those 500 companies collectively earn more money, expand their operations, and become more valuable, the value of your index fund grows with them. You are not betting on individual companies. You are betting on the American economy. And over any 20-year period in history, that bet has paid off. The cost of this approach, the expense ratio of a broad market index fund, is between 0.03% and 0.20% per year. The cost of the average actively managed fund is between 0.75% and 1.50% per year. The difference of 1% per year does not sound significant. Over 30 years on a $100,000 investment growing at 8% annually, the difference between 0.05% in fees and 1.0% in fees is approximately $140,000. Not from better or worse investment selection, from fees, from the cost of paying someone to underperform the index you could have bought for almost nothing. Shelley understood this in one afternoon. She has never paid a 1% management fee. She will not. The $140,000 she will not spend on fees over her investing career is $140,000 that will compound in her account instead. You do not need to understand the entire investment universe to build a complete, diversified, long-term investment portfolio. You need 3 funds. Let me give you all 3, and then I will show you how to collapse all 3 into one if even 3 feels like too many decisions. Fund 1. A total U.S. market index fund. This single fund owns a piece of every publicly traded company in America, approximately 3,500 companies, every sector, every size. When the American economy grows, this fund grows. When specific sectors struggle, the diversification across every other sector provides balance. The best options: Fidelity's FZROX, 0 fees, total U.S. market; Vanguard's VTSAX, 0.04% fees, total U.S. market; Schwab's SWTSX, 0.03% fees, total U.S. market. Pick one. Buy it. Never sell it. Fund 2. A total international market index fund. This fund owns a piece of every publicly traded company outside the United States. It provides exposure to the economies of Europe, Asia, emerging markets, and every other region where companies are publicly traded. It reduces your dependence on the U.S. economy alone, because over long time horizons, the outperforming economies are not always American ones. The best options: Fidelity's FZILX, 0 fees; Vanguard's VTSAX, 0.12% fees. Fund 3. A bond index fund. Bonds are lower risk and lower return than stocks. They provide stability during stock market downturns. When your stock market funds are losing value, bond funds typically hold steady or increase. The percentage of your portfolio in bonds should roughly correlate with your age. Younger investors hold fewer bonds because they have more time to recover from downturns. A common starting point: hold your age as a percentage in bonds. At 30, hold 30%. At 50, hold 50%.
The best option, Vanguard BND, 0.03% fees, total U.S. bond market. These three funds, U.S. stocks, international stocks, bonds, in an allocation appropriate for your age, held consistently, rebalanced annually, inside tax-advantaged accounts, represent the complete investment strategy that generations of financial research have converged on as the most reliable path to long-term wealth for most investors. That's it. 3 funds. And if 3 still feels like 3 too many decisions, if you want to collapse this entire strategy into a single choice that requires no annual rebalancing, no allocation decisions, and no ongoing management, there is a version of this that does exactly that. A target date fund holds all 3 of the above, U.S. stocks, international stocks, bonds, in an allocation specifically designed for someone planning to retire in a specific year. As that year approaches, the fund automatically reduces the stock percentage and increases the bond percentage, becoming more conservative as retirement nears, exactly as financial theory recommends. Simple. You pick the year. The fund does everything else. Fidelity Freedom 2025, Vanguard Target Retirement 2025, Schwab Target Date 2025. Any of these inside a Roth IRA, funded monthly with whatever you can contribute, requires exactly one decision, the year, and 0 subsequent decisions for the rest of your investing life. No rebalancing, no annual review, no decisions made during market downturns that the research shows most investors make incorrectly. The fund handles all of it. You simply keep contributing.
Shelley invested her
First $100 in the Fidelity Freedom 2025 on the Thursday evening after the lunch break conversation. She has increased her contribution 3 times since then. Her account is now funded automatically on the 15th of every month. She has not logged in to make an active investment decision since the day she opened the account.
Her account is growing. The compounding clock that was stopped for 4 years is running. The later tax she was paying is smaller every month. One decision, one fund, one Thursday evening. That is the entirety of what was required. Why women are built for this strategy. I said at the beginning of this video that when women find index investing, they use it. And when they use it, they build wealth at a rate that makes actively managed alternatives look exactly like what they are. This is not a compliment designed to flatter you into action. It is an observation grounded in the behavioral research on how men and women manage investment portfolios differently, and why the differences favor women in a passive investing context. Terrence O'Dean and Brad Barber at the University of California analyzed the trading behavior and returns of 35,000 investment accounts over 6 years. Their findings? Men traded 45% more frequently than women, and the increased trading reduced men's net returns by 2.65 percentage points per year. Women's lower trading frequency produced better net returns, not because they made better active decisions, but because they made fewer decisions that cost them money. The qualities that passive investing rewards most, patience, consistency, resistance to emotional reaction, willingness to hold through volatility without panic selling, are qualities that research consistently attributes more strongly to female investors than male ones. The strategy that suits most investors best happens to suit women particularly well. You were not born to be intimidated by the financial system. You were born to outperform it when given the same access and the same information. The access is a Roth IRA. The information is this video. The rest is time and consistency. And time is exactly what you have more of than you think. The 5 mistakes that derail index investors. Understanding the strategy is not enough. Most people who understand it still make one of 5 mistakes that significantly reduce its effectiveness. Mistake 1. Selling during a market downturn. The S&P 500 has fallen by 20% or more 9 times since 1950. It has recovered from every single one and gone on to new highs. Natasha is 38. She opened her first index fund account in 2020, 3 weeks before the pandemic crash that dropped the S&P 500 by 34% in 23 days. She watched her account lose a third of its value in less than a month. She sold everything. She locked in a 34% loss. She missed the subsequent recovery that brought the market to new highs within 5 months.
The cost of that one decision, approximately $40,000 in her specific account over the years that followed. When the market falls, and it will fall multiple times during your investing career, your only job is to not sell. That is the entire instruction. Do not sell. Keep contributing. You are buying shares at a discount. The recovery, when it arrives, will make the discounted shares more valuable. This has happened every time. There is no reason to believe the next time will be different. Mistake 2. Waiting for the right time to invest. There is no right time. The right time is always now, because the alternative to investing now is not investing at the right time later. It is not investing now and possibly not investing at the right time later either. Market timing does not work consistently for professional investors. It does not work for individual investors. Invest now. Invest every month. Dollar cost averaging, investing a fixed amount on a fixed schedule regardless of market conditions, automatically buys more shares when prices are low and fewer when prices are high. It is the mechanical implementation of the strategy most investors know they should follow and most fail to follow emotionally. Mistake 3. Checking the account too often. Carmen checks her investment account every day. She knows she should not. On the days it's down, which is frequently because markets fluctuate daily, she feels an anxiety that is disproportionate to the amount at stake, but impossible to suppress once triggered. The daily check is not information. It is noise. Daily movements of an index fund are random fluctuations that have no predictive value for long-term returns and produce only emotional responses that tend to work against the investor's best interests. Check your account quarterly, at most monthly, never daily. Mistake 4. Investing in too many funds. The three-fund portfolio is complete. It covers every publicly traded company in America, every publicly traded company internationally, and the bond market. Adding more funds adds complexity, potential overlap, and the cognitive burden of maintaining more than necessary. Simple is not naive. Simple is optimal. 3 funds is enough. 1 fund, if you use the target date option, is also enough. Mistake 5. Not increasing contributions as income grows. The index fund strategy compounds most powerfully when the amount being contributed increases over time.
Every raise, every bonus, every cleared debt that frees up monthly cash flow, a portion of each should flow to increased investment contributions. The lifestyle split rule from Script 2 applies directly here. Every income increase, 50% to contributions before the lifestyle adjusts. The compounding effect of increasing contributions over time dwarfs the compounding effect of any investment selection decision you could make. Shelley is 32. Her Roth IRA has $4,800 in it. That is not a dramatic number. It is not the number that changes her life today. It is the number that at 8% annual return over 33 years becomes $62,000 from one Wednesday evening, from one lunch break conversation, from one sentence that ended 4 years of financial paralysis. She checks her account quarterly now, not daily, not with the dread she expected, but with something closer to the mild, pleasant curiosity Maya described in Script 1, the garden tending feeling, the watching something grow feeling, the feeling that is the opposite of the 6:47 a.m. anxiety and closer to the 7:15 a.m. calm. She is not there yet, but she is on the way, and the way, it turns out, is exactly as simple as her coworker said it was. The investing shortcut financial advisors hope you never find is not a shortcut at all. It is a strategy built on 50 years of rigorous academic research, endorsed by Nobel Prize-winning economists and the most successful active investor in history, available to anyone with a Roth IRA and 15 minutes on a Thursday evening. Buy a low-cost index fund, total U.S. market or total world market, or a target date fund that holds both automatically inside a Roth IRA on a fixed monthly automatic contribution. Never sell during a downturn. Never wait for the right time. Check it quarterly. Increase contributions when your income increases. That is the entirety of the strategy. It is boring. It is simple. It is the most reliably effective wealth-building approach available to ordinary investors, and it is available to you right now, tonight, with no financial advisor required and no entrance exam to pass. 92% of professional fund managers underperform the index over 20 years. The fee difference between an index fund and an actively managed fund costs $140,000 over 30 years on a single $100,000 investment.
Women who invest outperform men by 40 basis points per year on average. The strategy that suits most investors best suits women particularly well.
Shelley found it on a Thursday evening.
So can you. Your one action tonight is to open your Roth IRA. If it is already open, log in and look at what you are invested in, and find the target date fund closest to your retirement year. If you're invested in anything other than a low-cost index fund or target date fund, look at the expense ratio. It's in the fund detail section. If it is above 0.5%, you are paying more than you need to for performance the research says is unlikely to justify the cost. Consider switching to the equivalent index fund. If you're not yet invested in anything, just holding cash in the account, pick the target date fund for the year closest to when you turn 65. Click Buy, set up a monthly automatic contribution, close the laptop. I will link a comparison of the target date funds available at Fidelity, Vanguard, and Schwab in the description, fees, holdings, and the one decision process for each. We'll be talking about the credit score in a future video, specifically the loophole that banks hope you miss, the number most women are calculating wrong, and the 5 moves that improve it faster than almost anything else the internet will tell you to do. Your credit score affects your mortgage rate, your car loan rate, your insurance premiums in some states, and your ability to rent the apartment you want. It is one of the most consequential numbers in your financial life, and most women have never been taught how it actually works. Subscribe so you're there. Share this video with the woman in your life who has been putting off investing because she doesn't feel like she knows enough yet. She knows enough. She has always known enough. She just needed someone to tell her the tab closes tonight.